mode.
Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending June 30th, 2017, which is also the end of the second quarter, and we're halfway through the year of 2017. And so far this year, we've gotten off to a really strong start, one of the stronger starts since 2013. The S&P is up a little over 8.2%. We've had 24 record closing highs in the S&P. The NASDAQ's done even better. It's up 14% with 38 record closing highs. And the Dow is about the same as the S&P, up about 8%, and the Russell is up a little over 4%. So needless to say, the first half of this year has been very strong. I do not, however, believe the second half of the year is going to be like the first half. Now, history statistically has shown that when we've had a good start like this, we also have a strong finish. But I believe the second half of the year, at least the way the charts are showing, clearly over the next 90 days, we're going to see some weakness. Now, we normally see weakness in the months of July and August, statistically going back 2 decades. July is one of the months where volatility finishes the month higher than where it starts. And we've also had a same thing in August, just until we get into the September-October timeframe. Now, we got a number of things that are coming up in a couple of weeks. We're going to have earnings kickoff for Q2. And we also had this past week, we saw a little bit more volatility come back in the market. It kind of started where I believe 2017 is going to mark the peak liquidity of central banks globally. You know, for over the past decade or two, central banks have pumped in. We've gone from about 3 trillion to about 19 trillion globally in balance sheets around the globe. And now for central banks, we started it with Mario Draghi and then Yellen and then Mark Carney coming out last week and talking about, you know, trying to normalize. We saw the markets react negatively to that, especially yields over in Germany. The Bund went down dramatically, or went up dramatically. The bond itself went down, or the German Bund went down, and that caused a big sell-off in the U.S. markets, and the dollar to go lower and the euro to go higher, and bring some volatility back into the market. So we got a number of, I think, events that are going to play out in the second half of the year. Some of them are going to be surprises. Some of them are going to be anticipated. Others will not. But I think the second half of the year is going to be even more fun than the first half, if you can believe it, as far as the markets go. What I've got on the screen here is a weekly chart of the S&P 500 futures. And I want to get rid of all of this stuff on the screen because it's probably kind of clouding everybody's view. Every line, every trend line, every indicator means something to me, but to you it may not. But let me just clear it up a little bit and leave just the Fibonacci on here. And I wanted to show you a couple of things. This is, as I said before, it's the weekly chart. And we've had, since this little downdraft right there, which was in November, all right, the first week in November when Trump was elected, you can see it has just really, the vector here has just been straight up. Not quite straight up, but it's been almost a 45-degree angle for those of you that understand vectors. And that is very steep, and we're not going to be able to maintain it. Okay, I mean, in fact, it's probably even higher than that if I were to just come up under here and highlight like that, right? But it's very similar, right? I mean, the distance is very similar. So it's almost, you know, almost probably, let's call it 40-degree angle to the upside. That's a very high inclination. Typically, when the markets start to peak and then they go over, this inclination increases up a little bit, it gives it up, and then we have a pullback. The other thing that I'm seeing here is I've got these Fibonacci extensions on here, and these were extensions off a prior pivot high, which was an extremely important pivot high. Going back to 2015, when we made all-time highs in 2015, it took us over a year to come back and take those highs back out, and then we had a retest, and then we finally took off with Trump right there. So I do believe that we're going to be spending the bulk of the time in the second half of this year in this area right here. The only thing, and I say the only thing, that is going to move the markets higher from here is a combination of strong corporate earnings and Trump getting his legislative agenda through, meaning more infrastructure build out, repatriation of money of corporate money offshore, as well as tax benefits. I think the healthcare plan, while it's important psychologically for a lot of the American voters, I think the bigger impact is going to be the tax stimulus or whatever they come out with there. We put those two things together, good corporate earnings in that, and then we're going to come back up and hit these extensions up here. We've kind of topped out around the 2452, 2453 area, but to get up to the 2500, we're going to need those magic numbers to come through. Yellen is already on course for saying she's going to hike the rates, but we'll go into the currencies in just a bit. So this is kind of what I'm looking at here. The other, at least I'm going to sign for the summer, coming into the summer months. You can see here on this weekly chart, we had this huge impulse move. We had what I called here a buy on the dip right there. That was a consolidation period here. But this area right here, I was encouraging our members to buy on this dip. And then when we had this gap up on that candle right there, that was when the French elections were submitted. And the populists didn't win. Macron won, and then that just took us up even higher. But I think this is the last venture up here to make from this high here to this high here. And then I think we're going to kind of come in. You can see here, we got what I call a poor man's bed for our members. They understand what it means. But essentially, it does show that we're going to have some coming weakness. I would not be surprised at all to see us come into the 2400 and probably take that out and just dip a little bit below that in the month of July, maybe even perhaps come down to the 2300 area. And now remember, if earnings, we haven't had a lot of downward earnings revisions yet into Q2. So if earnings are strong, that'll keep us propped up. But if they start to come in just a little bit weaker than normal, we're going to end up down here pretty quick. And you can see the 50 EMA. I'm sorry, this is on the weekly chart, but you can see this area right here is kind of where I see the higher probability of us settling in for the near term. And again, since this is a weekly chart, I would define the near term as the next 2 to 3 months, probably Q3. As we go into the, as we round out Q2, we come into Q3, I could see us in that area there. If I put us on a daily chart, we'll zoom in just a little bit more. You can see here on this daily chart, again, we're finding support. I mean, we don't venture too far below it, but we find support at the 50 EMA, right? And we just haven't really spent a lot of time below it. And when we do get below it, we don't venture far from it, and then we tend to move back up again. And on this 50 or this daily chart, we got a high and a higher high here. And you can see near term, there is no divergence. Further term out, there is a little bit. Again, this is what I would call a poor man's bed, which does suggest a little bit of weakness. And I was telling our members going into last week's trading, selling bear call spreads in, you know, the SPX or clearly the NASDAQ would make a little bit of sense. But this is kind of where we're seeing here, and I do see we're still in a buy on the dip territory. And if I were to draw a line here on 2400 as accurate as I can, you can see here the resistance, and then when we finally broke out here, we came back and did a retest. So I believe that is, you know, a higher probability of a retest of 2400, possible breakdown, come back and hit this next fib extension down around 2338 area, which you can see right here. We're fairly close to it. And when I take all of this off the screen, you can also see on here on the left-hand side of the chart, I've got these wider areas here, which is volume over price, which is where a lot of buyers and sellers are really duking it out, right? This is where the buyers are fighting the sellers to see who wins. And so they serve as natural support and resistance. And right now, the up in this area here, the seller is winning and pushing the price down. So now the question is going to be in this buying versus selling in this next big area here. You can see the fib node supports the bottom of it. So we're going to see, this will be our first big test as we go into July and August. Can this area hold? And then we go all the way down to a lower fib level right here. You can see at this area at the 38% extension on the fib. That's another area, but the big one is right in this area here, right? I mean, you can see it. So it's hard to get a read near term on this. Other than that, I think we're going to have a little bit of weakness here. We may get some fits and starts, and remember, we've got earnings coming in the next 2 or 3 weeks, and once those earnings start to hit, that's going to give us a good clue as to where we're going to end up here. So that is the overall take on the market here, at least the major index. And if I show you NASDAQ, you know, we saw this past week the best performing sector was financials. If I just come over here, we'll jump into the NASDAQ in a minute, but if I put the financials on, you'll see here that we had this breakout really right here. This was the first breakout, and I was getting our folks long the financial area here right at the 24 level. We had a breakout, a retest, but then we just went right up here, and a lot of it was well telegraphed with the feds doing the stress test on the banks to allow them to pay more dividends. But net, I think the financials, they're not going to get much higher than this. You know, it's going to take a little bit of time. And remember, they're really glued or super glued to what Yellen is going to do with interest rates. And right now, the 30-day Fed Fund futures is not forecasting a higher probability of rate hike this year, even though the Fed and Yellen is saying that they're on track to hike one more time. Right now, the Fed Funds is saying no, that's not going to happen. We're not seeing inflation. We're not seeing the kind of market environment that would dictate Janet Yellen to raising the rates. Hence, the dollar is selling off, and it's getting further exacerbated by Mario Draghi's comments this past week, along with Mark Carney, who's he runs the Bank of England. And so the dollar is just reacting negatively to all of this. And of course, if we come back and we look at the NASDAQ, where this past week the financials was one of the best performing sectors, and technology was one of the worst. You can see here, NASDAQ actually gave it up below the 50 EMA. Okay, you can see here that we're making a lower high and a lower low. There was that, and we could not get up there. There was the low right on the 50 EMA, and then we made a lower low there. Okay, we do not have a bearish divergence here. That would suggest that we will reach a point here where it's a buy the dip kind of moment, you know. So it's just, all it really is a wider channel in an overall up move, right? That's the way I would see it. And if I connected these two right there like that, you can see, now I didn't draw the line very carefully, but we had this kind of pattern set up, so that to me the key area is going to be right around in here, right around the 55.50 area. That's a key pivot. If we take that key pivot out, it's not going to be very pretty near term for the NASDAQ. It's probably going to come down to the 54.40 area, and then we're going to slosh around here. Again, what's going to hold it up are going to be earnings. We do not have any divergences here, so that shows a ton of money was being driven into the technology sector. Now we're getting profit taking right here, which is only natural. So some of the big tech stocks that have just been on a tear, you know, from the Apples, Facebook, Amazon, Microsoft, Google, some of the ones that have just really been, you know, killing it, or selling off a little bit in profit taking, but it's going to open up, because these companies are just as good now as they were 3 weeks ago, when, you know, before some of the selling started. So you're going to see some buyers come back in. I think some buyers, they're probably going to sit on the sidelines and wait until we get a clear read on earnings before they start committing a lot of big money back into some of these stocks again. So we're going to be in a choppy mode until we get through earnings, and earnings is going to be one of the drivers that's going to continue to prop the market up and drive it higher or drive it lower. All right. Right now, we're in a buy the dip mode, very similar to we were a month or two ago that I was talking to our members about. Okay. The Russell. You can see with the Russell, it actually is holding up because we don't have a drawdown in all the markets, most of the markets, but not all of them. You can see with the Russell, it's fairly strong. So we've gotten money coming back into some of the small cap and mid cap. The Russell is up in this area here. It's actually above the 50 EMA. Remember back over here, the Russell was underperforming. You can see that big, huge spike of buyers versus sellers here in this volume over price, sitting right at the open price of the Russell for the year. Now, it's not up as much as NASDAQ, clearly, or the S&P and the Dow. It's only up a little over 4% for the year. So, but this is the open price right here. But it's holding up in this tight range here. And earnings are going to keep it up. But if these other markets start to break to the downside and this starts coming down, then now you've got all indexes going to the downside, and that's when you're going to see more selling across all sectors, all markets. Right now we've got a little bit of sector rotation going on, so that's kind of what's driving some of this. If we come in and look at volatility, as I said, vol came back into the market this past week. We had a couple of spikes, nothing really serious, but and it didn't last very long, right? You can see here, this is zone 1, what I call zone 1 in vol, you know, basically south of around 15 VIX. You can see this huge spike right here in VIX. We came up to this area here, and then we ended up closing right back down here again. You can see these spikes here. So this is common, but we don't have follow through. So the volatility immediately comes back down again. All right. Now, when we get follows through, that is going to be a signal that the market's going to get a lot uglier. Like this is an example of follow through with volatility right here, right? What happens is you've got that initial spike where you come all the way up and then you get a move down like this, and then you have a chop up, down, and then up again. So when we get these repeated spikes to the upside like this and like this, right, then that's what gives you the bigger spike up into a zone 3 where the VIX is over 21. All right, so we're not necessarily done yet. This is just the first move here, and again, we're starting to see these spikes where up, down, and then up again. So these spikes are going to get more frequent as we go into the summer months, and you know, taking us back up here into the high teens for VIX. Now for our members, I'll go into ways, if you've got a non-portfolio margin account, a good way to hedge your portfolio. And if for those of you that have portfolio margin, I've got ways to you've got a lot of advantages that non-PM accounts don't have, and there's special ways that we can hedge a PM account that you can't do with non-portfolio margin. So these are some of the things that we can anticipate going into the month of July. If we look at the bond market, now the bond market gave it up. Look at this, guys. This is, now it doesn't look like much on a daily chart, but let me just zoom out here and I'll show you here. The bond market hit highs only on the 26th. All right, so at the beginning of the week, it hit highs for 2017. We came right into my target area. 157.04 was my target area. We hit 157.08, this shaded here. So I've had two targets on this that we were looking at trading here in our group. One was down here and one was up here. And both of them we came very close, right? And this one we were almost right on it. And now we've come down and we're sitting right below the 50 EMA, and you can see the trajectory of the 200 EMA is down and the 50 EMA is flat. So that does suggest that we're going to get some compression here, a little bit of chop in the bond market. But you can see the central banks coming down, driving the U.S. bonds down. Remember what I said, a lot of money in the U.S. bond market, right, came from overseas because the Bund, the best, lowest risk bond across all of Germany, the German Bund, was almost 200 basis points cheaper, less than over here in the U.S. So money came from over there into here into the U.S. Treasury. But as that yield starts going up, guess what happens? Money comes back out of the U.S. markets and back over there, right? Seeking higher yielding debt instruments over there. And when that money goes in that direction, well then guess what happens? That's a lot of selling. The bonds go down and interest rates go up. Now, you would think that in this scenario here with the interest rates going up, that the U.S. dollar would go up, but it's not happening. And the reason why it's not is because there's no inflation here, and when this is going up here, the interest rates going up in Europe, the euro starts moving higher. And as the euro moves higher, compounded by the pound also moving higher, right? The pound was moving higher. And Yellen, with lower inflation in the U.S., the markets are saying Yellen's not going to raise the rates this year. That's what the markets are saying. That moves the dollar lower, even though the yield this past week in the U.S. went up. So it's a common thread that if you pull all of this stuff, you can see, well, gee, if you pull the thread on your left sleeve, why in the hell is the right sleeve falling off your jacket? Depends on how the jacket's constructed. Right now, this is how this environment is constructed, and this is where we are right now. And I can tell you guys that with 19 trillion over the past decade in balance sheets, the U.S. alone has 4.5 trillion in our balance sheet. Trying to reverse and get back to a more normalized market, there is going to be shocks to asset prices and shocks to the system. I just don't see how we can't have some. That doesn't mean it's going to be one continuous shock, but there's going to be, scare the children moments in the markets. But this is the reason why we're seeing some of this crazy action that we're seeing. If we come into the 2-hour chart, you can see it's even more dramatic with the bonds. We hit our highs up here like this, right? Right, almost just literally right near where I was calling, and then the bonds just sold off. Boom. It happened very quickly in a matter of just a couple of days. And now we're sitting at this level here. I do believe that if bonds do get a bounce up in this area here, then I'm going to be working with our members to say, hey, we love that, because I think it's going to just bull trap people in, and then it's going to come right back down again. Okay. And logically, you would think, well, hell, if bonds are going lower, the dollar should be going higher. But that's the conundrum this year. That's the conundrum that Janet Yellen has got. At the end of the day, with a cheaper dollar, that's going to boost corporate earnings overseas. So that's a good thing for corporate earnings. It's also going to tend to boost commodities, because cheaper dollars buying most of these commodities. If we look at the euro, guys. Look at what it's done. I keep moving this almost every day I open this chart up. I have to move the 2017 high price. That's the euro. I mean, we're up near 114.7. We're up almost 115 in the euro. And it wasn't just, and this is a 2-hour chart, okay? This is a 2-hour chart. It wasn't but just, a few days ago, we were down around 112. If I put it on a daily chart, and I spend 2 or 3 months a year in Europe, and I wanted to see this thing down, but obviously the markets have other ideas. But just back in April, the euro was down around 105. I mean, folks, that is huge, right? Now, I don't think this trajectory is going to continue. I think what we're going to see is a little bit of a pullback in the euro, and we're going to have a more normalized trajectory like this. If you look at it, the trajectory has been like that. So the vector here is probably more than 50%, right? probably 55 or 60%. The trajectory here is probably about 35%. Even that is a huge trajectory. I think we're going to wind up back down in here again over the summer months, maybe going into the fall. I just don't see it maintaining this torrid pace here. In fact, we're getting some divergences, possible divergences setting up here. That would suggest the dollar is going to go higher near term, but not much, all right? So I'm looking for a little bit of a bounce. And speaking of the dollar, if we look at the dollar, look at what it's done. I mean, we've been in this channel going all the way back to the beginning of 2017. This literally is the first trading day of the year right there in the US dollar, right in that area there, January 3rd. And then guess what it's done? It's just been selling off, making the classic trend of lower highs, you know, and lower lows as we go down and we track this channel. So I do believe that it's time to get back up into this channel right here. Now, will it reach up there? I'm not really sure, but it's going to probably roll back over again. You can see the 5200 cross. Again, both of them are vectored to the downside. There's just too much weight, too much downward pressure right now on this. So, you know, even though logic would say, well, hey, if Yellen's already raised the rates 4 times in the past couple of years since December 2015, why the hell is the dollar going down? And the reason why is what's going on in Europe. That's what's driving the dollar lower, guys. Great trade opportunities, by the way. If we look at gold, gold has surprised a few people too. We're still in an up mode in gold. It's just very... It doesn't seem like it if you're trading it day to day. If you look at the width of the channel, you know, it's classic higher lows, higher highs. It's classic. But because of the width of this channel here, every time we're going down, it just gives the feeling that gold is, you know, just heading much lower. It's not. It's just that the vector of this is not flat. It's up, but it's not a very you know, it's probably less than 15% or so on this up move here. And then coupled with this wider channel, it gives you great swing trade opportunities or monthly opportunities. You know, when you're up in this area here and it rolls over, you want to be a seller, and down this area here, you want to be a buyer. I do believe, now I said in the first half of the year, gold was going to finish the year higher than where it started. We actually started right there. Now, remember what I showed you with the US dollar. In 2017, that was the peak of the dollar, and it started moving down. Well, gold is just the opposite. That was the low right here for 2017 for gold, and now it's moving higher. Typically, as the dollar moves lower, gold is going to move higher. So we started here, and we're right here right now. Granted, it's been very choppy, but we're higher. Now, I do believe we're starting the second half of the year here. I think the end of the year, we're going to finish probably somewhere up in this area right here, north of 1300. Again, it's going to be choppy. The only thing that would change my opinion and bias is if we start to take out some of these previous pivot lows, then that's going to probably turn into a more choppy sideways market. All right, and remember, a weaker dollar is a push for higher gold. That's one area for where gold can go. Now, the oil, we've been trading this every week. We've had 13 successful trades in a row. I said down at this level here, expect a bounce, and that's what we're getting. You're seeing this move up here. It's probably going to peter out somewhere in this area here, come back down, and then test this key low here or come close to it. If this low holds and it comes down, and let's say it stops here and then starts to move higher, then we could be forming the basis of a slightly upward vector for the second half of the year. Okay, there is no bullish divergence here. In fact, it's more bearish, which is why I believe once we get up to this area here, it's going to come back down again. And then this second area here and a retest of that prior pivot low is going to tell us whether we want to play for the next 90 days, bullish or bearish or slightly neutral. So we've had some successful trades in oil, and we'll continue in the second half of the year. We just got to take a look at the key pivots and where it seems like it wants to run. We've had some good moves in agriculture with the USDA report out this past week. We've had some home runs, grand slams in the softs with orange juice and sugar. We're not in those right now. So that's kind of where we are halfway through the year. I know that for our members this Sunday, we're taking the weekend off. It's going to be a long weekend for a lot of traders. It's 4th of July on Tuesday, which is an odd day. So for those of you international folks, the U.S. market's going to be closed all day Tuesday. They'll be open Monday, but they'll be closed on Tuesday. We will pick back up our sessions again on Thursday morning. If you're not a member, I highly encourage you to come in. We're halfway through the year. We've got some really great things in our Secret Trader. So for the July 4th, I'll put a little offer out there for you if you want to come into our Secret Trader membership. Otherwise, have a great long weekend. And members, I will see you briefly in our chat room on Monday because the markets are open. And then Tuesday, we'll go out and eat a lot of steaks, hamburgers, and hot dogs, and a lot of cold beer. All right, folks, have a great weekend. See you guys later now. Ciao.